Do you want to buy a home but afraid you can't afford to? Then stay tuned as we show you how you can buy a home with zero down or a small down payment and save thousands in home loan interest while you're at it. That's coming up next.
We're Glen and Kelly Nelson with Realty One Group West, and we recently sat down with a trusted mortgage advisor who gave us the inside scoop on home loan options and how you can save lots of money in the process. Subscribe to our channel for weekly content on how to save lots of money and time when buying or selling a home. Just click the red subscribe button and hit the bell button to be notified of new videos.
We recently sat down with Keith Murphy, a 25-year seasoned mortgage advisor with Essex Mortgage, to get an insider's view of all things home loan related. This video is the third in a series relating to credit scores and how you can save lots of money on your home loan. If your credit score is obviously what you want to drive it up, you want to have it 740 or above. If I don't have it at 740 or above, what then? How is that going to impact my loan?
Okay. Well, it depends upon what kind of loan you're going after.
Okay.
All right. So if you were going for an FHA loan or a VA loan, from credit scores of 640 to 850, which is about as high as they ever go, and most people never see that, the interest rate's going to be the same.
Okay.
There isn't going to be any higher interest rate adjustments between 640 to whatever the top tier. When you go below 640 on FHA and VA, there are loan level pricing adjustments or risk management charges by the Department of Housing and Urban Development, which means we have to charge a higher rate to cover these risk management fees. And the fees keep going higher as your FICO goes lower. We can fund loans with a 580 credit score, but you're going to pay almost a 0.75 percentage point higher interest rate as an example.
That risk management fee basically just means that I have less than stellar credit, less than the minimum of what would be less than stellar credit, and therefore the lender or the government entity, FHA, sees me as being more of a risky borrower. There's more likelihood that I might default.
Well, it's statistically you have a higher rate of default on lower credit scores than you do on people with higher credit scores. So they're weighing that, and there's a dividing line between this is getting too risky, and in order to capitalize the loans, they have to increase the delivery fees, increase the rate to get a market so people will buy those loans.
Okay.
Now that's for government loans, and I should also point out that the mortgage insurance premium, the MIP on an FHA loan, doesn't get affected based on your credit score.
Oh, okay. Good to know.
Now let's switch gears to conventional financing. That's a whole nother world. So back to those loan level pricing adjustments, if your FICO score is below 740, you're going to incur some form of loan level price adjustment, even if your FICO is 739.
Okay.
As crazy as unfair as that sounds,
the cutoff
Fannie Mae
point
and
is
Freddie
the
Mac,
cutoff
yes,
point.
there's levels. So they go from 740 down to 720, 720 to 700, 700 to 680, 680 to 660, 660 to 640, and then 640 to 620.
Okay.
Each one of those levels equals a higher interest rate and higher mortgage insurance premiums.
Okay.
So the FICO score is really, really important to get the best loan terms on a conventional loan.
Okay.
What I would also say is, if you have credit issues or are afraid that you won't be able to qualify based on your credit, don't try to be your own underwriter. Call someone like myself, have it professionally analyzed, and have someone coach you. Don't pay them for this.
Right.
Have them advise you and coach you on what you need to do to get yourself in a position. Don't just throw in the towel and say, well, my scores are low. I had some history back when I was in college. I made some bad decisions, and I'll never be able to buy a home. There's always a way. There's always a path to where you want to be. It just may take a little bit of work.
Right, and good point there. We just have a buyer that I started working with just over a year ago, and referred them to you. And they worked with Keith for 12 months to work on their credit, get their credit scores improved, get some credit issues like collections resolved. And here they are, and we're going to be closing escrow in about 3 weeks on their first home. So they worked on it, and they took all of your advice, and here we are. They're buying their first home. That's exciting.
And not to self-promote, but it is exciting. They had FICOs that were low enough that a conventional loan didn't make sense before.
Yes.
And we were having to look at FHA financing. And if you want to know the difference between the FHA financing and conventional, watch one of the Nelson's earlier YouTube videos explaining the differences, but there's distinct differences. And they were basically only accessible to finance a home with FHA.
Right.
Now they're in the upper tiers, the upper
Right.
echelons credit score wise, so they got conventional financing at the best prevailing rate, and the
Right.
PMI, because they didn't put 20% down, they have the lowest PMI factors available in 12 months.
Right.
With a little bit of work and some due diligence.
Yes.
It took them a year, and here they are.
Right.
So good
But
job.
they listened. Well, good job on them, on to you. Thank you to you.
How about
and,
routine?
Yeah, there we go. So just to let you know, have possibility thinking. And the other thing that Keith just mentioned, I want to, he just briefly alluded to it, is don't pay for this information. There are fantastic mortgage advisors out there for you, such as Keith. There are so many resources available. Google things. Don't totally self-diagnose. Read a lot, and then sit down with a good mortgage advisor who can run your credit and tell you what you should do, and kind of give you a path to follow, and a plan and a program, and then follow that program. So next thing was obviously, so I'm just in summary from what I'm hearing you say, is that having that excellent credit score is going to be able to get me the lowest, or as low as I can possibly get, in what, depending on what prevailing rates are, depending on the different type of financing that I have. It's going to save me money, the cost of getting the loan, and it's going to save me, if I have mortgage insurance, I'm going to get conventionally at least, I'm going to get the best mortgage insurance rate.
Yes, absolutely. And I think it's also important just to note, because we aren't, none of us are taught this in school, not in elementary, secondary, high school, or college, how important it is to have a good credit score.
Right.
So it not only affects your mortgage, but your credit cards, your
It
auto
can affect
loans.
employment now.
Yes. So it's really something that you should take seriously and understand the dynamics of the algorithms, how to game the system, and how to get yourself in a position that no matter what you finance, whether it's a credit card, auto loan, or applying for a job or getting a mortgage, that you've got, a leg up on the system.
Exactly, right. For more great tips on how to get the best loan for you and save money in the process, be sure to get Keith's Home Buyer's Handbook. Just click the link in the description box.
Thanks so much for joining us. Don't forget to subscribe to our channel and get all the other videos in this series, which will help you save lots of money on your home. We'll see you next time.